In this video, we are going through chapter 2 of the book, and the chapter is entitled Introduction to Transaction Processing. Now here is a list of the objectives that the chapter intends to address. As before, I will not go through each one of them individually, but I will ask you to do that. So I will urge you to do that before going through the chapter. Look at the objectives, go through the chapter, and then come back and convince yourself that you have in fact been able to address all of these objectives. Okay, now in chapter 1, we talked about transactions. We defined a transaction and we talked about that idea of atomicity, that transactions are always excuse me, supposed to satisfy that a transaction must be atomic. It must either all commit or all fail. So it's an all or nothing kind of arrangement. And when talking about information systems, trying to distinguish between accounting information systems and other types of information systems, especially the distinction between accounting information systems and management information systems. We said one of the key distinctions between an AIS and an MIS is that an AIS deals with financial transactions. And we also said that yes, a financial transaction is an economic event that one affects the assets and equities of the firm, two is reflected in its account, and three is measured in monetary terms. And often when talking about transactions, implicitly we may be thinking about transactions that a firm engages in with external parties. But we must always remember that some transactions are in fact internal. They are events that are internal to the firm. Talking about exchanges with external parties, we may be thinking about things like sales. For instance, when we sell as a firm, we sell our products to our customer, or we sell our service to our customer. Or perhaps we are buying raw materials that will go into the manufacture of whatever product it is that we manufacture. Or sometimes we are paying our financial obligations, for instance, paying tax to the tax authorities. So those would be economic exchanges with parties that are external to the firm. But also there will be, what you may call internal events. Things like depreciation of fixed assets. Those are things that we do internally that do not involve any external parties. Or for instance, when we are accounting for the labor that goes into the production of some item, how many hours did a technician put into the manufacture of this particular product? Or when raw materials are moving from one department to another. So those would be things that, well, not raw materials, but when inventory, is moving from one department to another. So those would be things that are internal to the firm. So keep that in mind, that when we say transaction, we are not only thinking about things like sales and that involve parties that are external to the firm, but even things that are totally internal to the firm. So that is the idea of a transaction, of a financial transaction, that distinguishes then your AIS from, for instance, your MIS. And in a typical scenario, a business, has many customers, and therefore there are many transactions that will be occurring daily. Take, for instance, your favorite supermarkets. Throughout the day, there will be people buying items from the supermarket. So there will be lots of transactions. Or if we escalate it a little bit and we think about your favorite online bookshop that has in fact now gone into selling electronic equipment and clothes, and so there will be many transactions per day, customers from across the globe buying things from that particular outfit. And so the volume of transactions that the company has to deal with will be huge. And so it is important that the company finds an efficient way for it to deal with that large number of transactions. If it doesn't do so, and the number of transactions then overwhelm the company, then it means, of course, that potentially the company now will lose business. If, for instance, the systems collapse because of the amounts of work that they are exposed to, then during the time that the systems are down, during that downtime, the company loses revenue, because now the potential customers may turn away and buy from somebody else. And also it might have long-term implications. Once your customers lose trust in you, once they begin to become comfortable with the idea that in fact they could buy from somebody else, then perhaps they will not be coming to you. So the implications may also be long term. So it is important that the company finds a very efficient and stable and reliable way of dealing with the large volumes of transactions that come its way on a daily basis. And an approach that has become quite common is then to group together transactions into what are called transaction cycles. The idea is that similar transactions will go into one transaction cycle. So effectively, this is a way that we classify transactions. For instance, if you look down here, the three transaction cycles that in fact we will be covering in this course: the revenue cycle, the expenditure cycle, and the conversion cycle. The expenditure cycle, for instance, is where you are saying, well, in order for us to manufacture whatever we manufacture, we need, first of all, to incur costs. For instance, acquiring raw materials. And so all the costs that relate to us getting the raw materials that we will need to produce our product, we will group them together in what we call the expenditure cycle. And once we have all our raw materials and all our labor, and now we're in fact producing the products, we are converting the input into some output, then we go into the conversion cycle. And so all the transactions that occur, then we group them together and we call that class of transactions the conversion cycle. So essentially the idea of a transaction cycle really is to group together transactions that we believe are similar, and that in the long term then allows us to process transactions efficiently. So there will be different transaction cycles that we identify and that we'll talk about in this course. But and they are different because of the nature of the transactions that they group together. The expenditure cycle groups together transactions that pertain to, for instance, us acquiring whatever we need to acquire in order to produce our product, and the conversion cycle groups its own transactions. But even though there are differences, there will also be similarities. So here are some things that are common across all the transaction cycles. A transaction cycle will capture financial transactions. Obviously, we are talking here about accounting information systems, and therefore we're interested in financial transactions. And it will record the effects of transactions in accounting records and also provide information about transactions to users to support their day-to-day activities. And these transaction cycles will produce much of the raw data from which we then later on will be producing management reports and financial statements. So the transactions, yes, are grouped into different transaction cycles, but cycles, although they contain different kinds of transactions, all the transactions, of course, are financial, and these are the things that then are common to all the transaction cycles. Later on, chapter 4, we'll talk about the revenue cycle in detail, and then chapters 5 and 6 will cover the expenditure cycle, and in chapter 7, we'll talk about the conversion cycle. But in brief, let's go through these, especially these 3 transaction cycles. Let's go through them in brief so that we appreciate perhaps where we are going. So let's begin with the expenditure cycle, and as it says here, think about a firm that is making some product. Perhaps we are making tables and chairs. Now, for us to do that, for us to make a table or a chair, we need raw materials. We need labor. And so the expenditure cycle groups together transactions that pertain to that phase of the production cycle. When we are acquiring the raw materials and the labor and the things that we will need for us to start manufacturing the tables and chairs. So we incur some expenditure to acquire the resources that will go into the production of our tables and chairs. And yes, most of the time, expenditure transactions will be based on credit relationships. In other words, we place an order, the supplier supplies, we don't pay immediately. Perhaps our supplier says to us, you have up to 90 days to pay. So the actual disbursement of the funds to pay for the raw materials that we got from a supplier will come later. So in the area of information systems generally, because the systems that we deal with are complex, we need to find ways of managing that complexity. And one common approach is to break down a system into a number of subsystems. We talked a little bit about this in chapter 1. And so in the expenditure cycle, you may identify 4 major subsystems of your accounting information system. So let's look now at the 4 major subsystems of the expenditure cycle. The first system recognizes the need, of course, for us to acquire physical inventory and all of that. And when we do that, we are buying goods from a particular vendor or maybe several vendors. The goods are received, and remember, we are going to pay at a later date. But we need today, when the goods come in, to reflect in our books the fact that our inventory level has gone up. Items have come in, so the amount of inventory has gone up. And then also we need to reflect in our books the fact that now at a later date, we will need to pay for those goods and services. So those are the two things that this subsystem will mainly be concerned with. The fact that there's been an increase in our inventory, and now we also need to worry about accounts that are payable, that at some point in the future we will need to pay. And then, of course, that future date ultimately will come. And when it comes, it means that now that obligation needs to be addressed. And so we need a system now that deals with the disbursement of cash. So that system now will be concerned with things like how do we authorize the payment? How do we ensure that we are paying for things that we really should be paying? So there should be ways in which we check and we can say, okay, this payment is authorized, and the payment can actually now be made. The funds are dispersed to the vendor, and we need, of course, to make a record of that transaction. So it means now that our levels of cash go down, but also so do our accounts payable. Remember, this went up when we received inventory, and we said, okay, we'll pay for these at a later date. And now that later date has arrived, we need to reflect the fact that we are in fact paying for that item. So these two subsystems will be covered extensively in Chapter 5. But the expenditure cycle also has two other subsystems. Remember, we said there are 4 major subsystems. And what are the other two? Well, the other two are concerned with the payroll and the fixed assets. As we manufacture our tables and chairs, we do so through our employees. We have employees who are working on this project, so who are cutting and machining and whatever needs to be done. And so we need to be able to compute how much, for instance, to record how much, for instance, how much time each employee put into the project. And that will then tell us how much we need to pay, how much we need to pay in terms of labor for that particular product. This information is important because ultimately it will also influence how much we charge our customers for that particular product. It'll help us in the future thinking about planning and budgeting. So and as it says here, conceptually, your payroll is a special case purchase and disbursement system. So this just talks about the payroll, but also we need to think about the fixed assets that also are involved in the manufacture of our products. And when we say fixed assets, of course, we are talking about relatively permanent items that collectively represent and then the firm's largest financial investment. And we're thinking about things like land and buildings and furniture and machinery and motorcycles. So we need to account for all of these things. And these two then will be covered in detail in Chapter 6. So if we go back a little, so in the expenditure cycle, when we are acquiring the resources that we will need in order to be able to manufacture a process, the things that will go into the production process, and we are talking about here, we talked about the inventory and the fact that we receive the inventory and we receive the items and we'll pay later. And when we receive the items, our inventory levels go up, but we also need to establish accounts that indicate that in fact there's a liability that we need to deal with later. And then when that later date comes, then we deal with that obligation. We pay our vendors. We disperse cash to our vendors, but also we need to account for the labor and the fixed assets that go into the production of our item. Sometimes when people are making things, particularly for smaller businesses, perhaps even where the business is really just an individual, um, people forget to account for their fixed assets. For instance, they forget that they need also to account for the amount of work, the time and effort that they put into producing their product. For instance, if you are selling fat cakes, you may be concerned about the raw materials, the bread flour and the cooking oil that you get, and you forget about the fact that you are putting in time, that you also need to cost, that you also have fixed assets that you need to think about. So these are things that we need to keep in mind. Okay, now that we have our raw materials, we have our labor, now we can actually go into the business of producing the products, into the business of converting wood into tables and chairs. And when we do that now, we are in the conversion cycle. All the transactions that relate to the conversion of the raw materials into the final products, we will group them into what we call the conversion cycle. So in the conversion cycle, the two main systems are the production system and the cost accounting system. And the production system, we're interested in the planning and the scheduling and the control, the things that we are doing to produce the physical products. And also we are looking at the things that require the raw materials. So now we go to our warehouse to retrieve raw materials. We authorize employees to do work. And we direct the movement of the work in progress through the various stages of manufacturing. So perhaps at station A, there's a little bit of work that is done, and then this work in progress moves to station B, where a bit more work is done, and then moves to station C, where perhaps it is now finalized. So all of that will be managed through the production system, and as that physical work is going on, and as that work in progress is going through the pipeline, we need to be monitoring the costs associated with all of that. So the cost accounting system will be responsible for that. And ultimately, of course, the information that comes from the cost accounting system can be used for things like budgeting and cost control and all of that. So the conversion cycle is all about the firm converting the raw materials into a finished product. So all the transactions that relate to that conversion of raw materials into your final product will belong to the conversion cycle. And of course, we may sound like we are talking only about manufacturing firms, but even service and retailing establishments also add value somehow, and that phase where they're adding value would be their conversion cycle. So they will add value so that ultimately they end up with a service that a customer is willing to pay for. So the phase during which they're adding value would be their conversion cycle. In any case, we will talk extensively about the conversion cycle when we go through chapter 7. And once the product is ready, now of course we want to sell it, and so now we move to the revenue cycle. And all the transactions that relate to us selling our finished products to customers will be grouped together collectively under the revenue cycle. So for instance, we will be processing cash sales where people come and pay cash for products, or credit sales, or so all of that will be under the revenue cycle. And the subsystems here, sales order processing, where people perhaps give us purchase orders, and we generate sales based on that. We generate sales orders based on that. So we need a sales order processing subsystem, but also we need later when people start paying, we will be receiving cash, so we need a system, a subsystem that will deal with that. So even for credit sales, at some point people start paying, and so there's cash that is coming in, and so we need a subsystem that will help us with the processing of that cash, collecting the cash and depositing it in the bank, and all of that. And we will talk again in detail about the revenue cycle when we cover chapter 4. Here then, in summary, are the transaction cycles and how they relate. Looking at this diagram, you could in fact impose, if you still remember, the diagram of a system that we talked about. Just the system, not when we're talking about information system, but when we're talking about a system where we said that a system takes in inputs, does some processing, and produces output. So you could say, well, this is where the system is taking an input. This is where it is processing that input to produce some output. But you can say that the expenditure cycle and its subsystems are captured here. So and we said this is where we are acquiring essentially the raw materials that we need for us to be able to produce our products. So all of those things, the labor and those raw materials and the fixed assets will feed into the conversion cycle. So the conversion cycle will in fact be using all of this to produce a finished product that will ultimately then go into the revenue cycle, where we can now sell that finished product to customers to generate revenue for the company. And some of the cash from that cycle, of course, will go back to the expenditure cycle to assist us to acquire the things that we need to do as we continue with our manufacturing process. So in summary then, these these are the transaction cycles, and yes, we will talk about them in detail later, but take the time to appreciate what is going on so that when we come back to them later, you are better prepared. Okay, so we have covered the first two objectives of chapter 2, and now let's move on to the next one.